So, on the financial literacy side, we look at both the situational analysis and a comparative analysis. So, here I want to talk about that situational analysis. How do we look at the financial statements, analyze them, get some information from them so we start to understand? So, it's really about examining the existing financial statements to find the big changes and looking at the idea of using ratios to compare firms on a relative basis of things like profitability, short-term solvency, activity, the cash conversion cycle, financial leverage, value. And so when we do this in terms of profitability, we start to look at things like profit margins, asset usage based types of items like net return on assets, gross return on assets. We can do it equity based in terms of return on equity. And remember, this is industry dependent. These will change, and you generally will need some information about the industry to make some comparisons to see where this firm fits within the industry itself. We can also look at things like short-term solvency. How does the firm have the ability to pay its bills? Things like the current ratio, the quick ratio. And I think the big thing here is higher ratios are better, and they're ideally above one. Above one means, yeah, they're able to meet the short-term payments that they need to pay out, and they have enough money to at least survive on a short-term basis. Activity-wise is really about how effectively the assets are being managed. And so we start to look at things like total asset turnover, receivables turnover, inventory turnover. And again, higher ratios are better. We can also look at other types of things like the average collection period, where a lower ratio is better. But looking at in terms of, is that firm managing its assets properly, or do we need to have something within the solution we're looking at to help that firm be better financially, at least in a situational way. Cash conversion cycle, looking at the days inventory outstanding, days receivable outstanding, days payable outstanding, looking at how fast inventory is sold, how long does it take to collect on that, how long does it take vendors to pay. And again, you'll notice here that it varies in terms of whether lower or higher is better. But the idea here is to look at how efficient is that firm in getting cash in order to pay its bills. We also want to look at financial leverage, things like debt, equity, and there's a number of ratios you can use here in terms of debt ratio, debt to equity ratio, interest coverage. But looking at the idea that, is there enough money supply? Do they have enough in terms of financial resources in order to carry out what you're looking at? Again, this will be industry dependent. Some industries are much more debt reliant than others. Others are more equity. You have to think also about debt, that it's senior to equity, and you have to be able to make those interest payments on it. Equity is money invested. It results in ownership. So there's issues around ownership that we can talk about in a later video on financial literacy. And it can result in loss of control depending upon how that equity is structured. So another thing to think about as we talk about this is, how is the equity structured? How can it be structured in order for the founders to keep control and still suffice enough so that investors are interested in investing in the company? And looking at sort of the overall value. What's the market value compared to relative other companies in its peer group? So price to earnings ratio, deal dividend, really what's the market's perception of growth prospects is what you're really looking at here. Is there an idea that, yeah, there's some growth here, there's possibilities for growth here, how big is it? And then that gives you a bit of an idea in terms of who might be interested in actually investing and helping the company obtain the resources it needs to carry out the solution that you're proposing.